Hi everybody, welcome to another video of what's moving the markets. So as most of you probably know that the market went down yesterday quite a lot as the Federal Reserve announced that it's reducing interest rates. And for some of you that might feel like, why did the market go down when the interest rate is going down? Isn't it supposed to be the other way around? Well, the market didn't react like that because the interest rate went down. That's usually a good thing for the market. The market reacted like that because of what was the forward guidance the Fed gave, right? In terms of what they feel is going to happen in the future. And that's what we're going to discuss today. That what exactly is the guidance they gave? How is it different than what was the guidance they were giving before? What really has changed? And what does that mean for equities, US equities? And what does that mean for emerging markets and the world in general, right? So, what's really happening in all markets? And this updated guidance by the Fed, what does it mean for all the global opportunities that we have? So, if you remember, we talked about this when the Fed started cutting the interest rate and they started with a 50 basis point or half a percentage cut. And at that time, some people were saying, oh, this is going to be a very, very fast easing, which means they're going to cut interest rates very fast. They've started in a big way by half a percent, and it's just like 2001 after the dot-com bubble burst, or it's just like 2008 after the global financial crisis. And even then, the knee-jerk reaction of the market was that, oh my god, it's all doom and gloom, the Fed has cut in such a big way, the economy must be about to crash, and the market had reacted negatively. But then the next day, the market recovered because people realized that even though the Fed started cutting the interest rate in a big way, they were not going to continue with such big cuts and they were looking at a much slower easing. So, this is what they were looking at the time, which is the September projection. And we had covered this in detail. Since September, we have been covering this. But now, what they are saying is that the easing is going to be even slower, right? Which is a good thing because what they're really saying is that we don't need to cut interest rates that fast because the economy is not that weak, and rather the economy is so strong that they're worried about inflation. So, initially, when they had started cutting, the Federal Reserve has a dual mandate, right? On one end, they want to keep the economy as close to full employment as possible, which means they want unemployment to be very, very low. And the second thing is they want inflation to be stable around 2%. So they weren't worried about inflation then, they were getting a little worried about unemployment going up. That's why they started cutting. But then they said, listen, we're not that worried about the economy. The economy seems strong, labor market seems good, unemployment is very, very low. So we're going to do a very slow easing. And now they've said we're going to do an even slower easing because we're not that worried about unemployment. Rather, we're still more worried about inflation. So inflation is coming back, and uh, most likely they are anticipating what will happen with the new administration of President Trump, and they're just mentally preparing everybody that we might have a slower easing, and they might even keep the interest rates higher for longer. And this is nothing new for us, right? I mean, we've anticipated this, we've talked about this, and we knew this was going to happen. But for some reason, the market participants were not as ready for this as we were. So they showed a knee jerk reaction and the market went down a lot as this forward guidance was given. Not all sectors reacted the exact same way. So mostly growth sectors took a much bigger hit, but there are exceptions within those growth sectors, right? So some technology companies have been very, very resilient, especially those so application layer software companies which we have been talking about and continue to think that are very, very good. and they're not really growth companies because their existing cash flows are so good and so solid that they're like a combination of a value and growth company, because they have value in them as well, because their today's earnings are very high cash rich, plus their future growth potential is there as well, right? So they've got best of both worlds. So within that, within the tech space, within the growth space, of course, your big application layer companies like Microsoft, Google are very well placed. And then, of course, within your value space, there are a lot of good options as well. And we will discuss about all the sectors again. Uh, Plus, because of this Federal Reserve hawkish guidance, which basically means higher interest rates, very good for the dollar, and almost 100% of the world's currencies went down compared to the dollar yesterday, and the dollar went up across the board, right? So, very good for the dollar. And what does that all mean? So, now we're going to basically get into discussion about this hawkish guidance. What does it mean for the US market, the different sectors in the US market, and then we'll move on to emerging markets, talk a little bit about that, different countries, and then finally we'll come back to the US market and talk a little bit more about some companies that we had talked about earlier that could be candidates for further research by you. Again, not investment advice, do your own research, but we'll just indicate some companies that might still be good ideas to continue to look at. Right. So obviously, interest rate going down is a good thing because the borrowing cost goes down. But then again, they have said that we're not going to reduce much more, and they're probably interest rates are probably going to stay higher for longer. So there's going to be slower cuts, and that of course dampens the enthusiasm for growth sectors, which are much more sensitive to higher interest rates because their cash flows are coming out much later into the future, right? And they have to be discounted back to today to get the present value. And a higher interest rate obviously means that it's a much bigger discounting impact on those cash flows. So the higher discount rates obviously weigh in on those growth sector valuations, and they face valuation pressures. Therefore, you can see that in the market, people would prefer value stocks versus your tech heavy growth stocks, right? So there's of course a preference for financial and industrials, and financial especially because they're benefiting from the higher interest rates, higher for longer, and industrials also because of the expected policies of the new administration, with the domestic spending expected to go up. And these are things we have talked about earlier, and we will talk about them again shortly towards the end of this video. But before I do that, let me reiterate and re-emphasize that when I say investors moving away from tech-heavy growth stocks, that does not include companies like Microsoft and Google, because those are not just growth stocks; they are the best combination of value and growth that you can find, because their cash flows are rich today. They're as much as value as they are growth, and they've been performing very well, right? And they're really sweetly positioned to benefit from all this AI growth as well. So this is something we've talked about many times before, and you even saw the great returns on Google, especially after the announcement of Gemini 2.0, right? So keep that in mind. Now, what happens with the dollar getting strong? Obviously, if you're a US company and you're exporting, then because your dollar is strong from the buyer's perspective, right? So it becomes more difficult for them to pay you, and then your exports take a hit. However, it's not all bad, because the local economy obviously buys in dollars, and the domestic economy is very strong. So there's still a huge plus for financials because of the higher interest rate, industrials because it's mostly domestic, and healthcare also again domestic. Export heavy industries, on the other hand, of course, are losing out because their customers now have to pay more in their respective local currencies because they have to buy a more expensive dollar, right? as the economy, of course, takes a hit and slows down because of the higher interest rate, means the economy is going to shrink a little bit. So as the business cycle slows down, it's bad for discretionary spending. People are going to stop taking out new loans. They're going to cut back on their credit card spending. So the discretionary purchases goes down a little bit. And of course, for tech, we've already discussed that they are going to face valuation pressures because of the higher discount rates start weighing in on the growth stock valuations. Now, moving to emerging markets, and this is going to be an interesting discussion because you'll see names like India being repeated in multiple places. And it's not for the same reason, it's for different reasons, but it's all in a positive way. So, India is winning because of multiple different reasons. Number one, it's not a big borrower, and rather it has a lot of dollar reserves. So if the dollar gets strong, a company which is borrowing and has a huge cost of debt in terms of a dollar denominated debt, then they're in trouble. But if a country has dollar reserves, then obviously they benefit from a stronger dollar, right? So India is winning on that end. Plus, like we discussed last time, that if US is going to try and reduce their trade with China, then countries that win because of that are like Mexico, Vietnam, and India, that they get to supply to the US economy um, instead of China, right? So the market share of US buying goods increases from India, Vietnam, and Mexico, and reduces from China. The third thing is that because of the tighter market, the monetary policy being tighter by the US, Federal Reserve, means commodities will face pressure because of course it will dampen the demand globally because of the higher interest rates, and that will mean reduced inflows for countries like Brazil and South Africa, which export these commodities into the US market. It will also hurt oil prices because, again, as the economy shrinks, demand shrinks, and then demand shrinks and prices shrink. And if prices for oil continue to go down, so that's bad for exporting countries like Saudi Arabia and Nigeria, but good for oil importing countries like India and Turkey. So, overall, negative for Brazil and South Africa because of the reasons shared here, that their commodity exports will likely go down, but positive for countries like India, Mexico, Vietnam, because of number one, the trade and supply chain realignments from China to these countries, and number two, of course, India also benefits from the lower oil price. Now, coming back to the US market, and there is literally nothing new over here. Our analysis has not changed because this is not something unexpected. This is what we have been saying since September, that there is going to be a slower easing. If anything, it just reconfirms what we have been saying, that the easing is going to be even slower than what they were saying before, right? Which means the economy is very, very strong. US economy is very strong, and interest rates will stay high for long. So obviously that is good for financials. JP Morgan, Bank of America, they are in bumper profits, right? Again, technology companies, yes, growth oriented companies are vulnerable, but that does not apply to companies like Microsoft and Google. They are as much as value as they are growth. They've got that whole AI application layer growth coming in. So those are still fantastic plays, and they have been performing and will probably continue to do so. In the industrial space, focused on domestic spending to benefit from domestic infrastructure spending, Caterpillar and Deere remain very, very sweetly placed. And within energy, of course, you've got your renewables, First Solar, Tesla, plus, and because obviously the link is there between First Solar and Tesla. Plus, of course, you can continue to play on companies which are focused on shale, so that's sweet crude exploration as well as refinement. So all of this we've discussed many times before, nothing new, just reconfirmation. right? So as always, if you found it useful, please like, share, and subscribe, and leave your comments below. We'd love to see your comments and continue to get more motivated to keep updating the content for you. So thank you for tuning in, and hope to see you next week.